You know, in every single business valuation, there's one number that holds more power and causes more headaches than any other. It's called terminal value. And if you get it wrong, you can wreck your entire analysis. So today, we're going to pull back the curtain and figure this thing out. So here's the big puzzle at the heart of all of this. We know the value of any asset is just all of its future cash flows added up. Simple enough, but a public company, in theory, can last forever. So how in the world do you add up an infinite number of cash flows? The short answer is you can't. You need some kind of closure. And as finance professor Aswath Damodaran says, even for companies that do stick around forever, their best days, that incredible hypergrowth phase, won't. Eventually, every high-flying company has to slow down and just mature. And that idea, that concept of closure, is the key to solving our forever problem. Okay, so we can't forecast a company's financials out to infinity, right? But we also can't just stop our model at year 10 and assume the company is suddenly worthless. That makes no sense. We need some kind of tool to capture the value of all those years way out in the distant future. And that tool is the terminal value. I want you to think of it like a bookend. You spend all this time forecasting the first 5 or 10 years in detail, and then you use this one single number, the terminal value, to represent the entire value of the company from that point on, forever. And you'd be shocked. It often accounts for a huge chunk of the total valuation. So, how do we actually calculate this all-important bookend? Well, there are 3 common methods people use, but as we're about to see, only 2 of them are actually, legit. All right, so our 3 paths are liquidation value, which is basically just selling off all the assets. Going concern value, where we assume the company runs forever at a nice, stable pace, and the multiples approach, which uses a kind of shortcut based on a future year's earnings. So let's look at those first 2 paths. Liquidation is pretty straightforward, right? You see it a lot with private businesses. The owner just decides to sell everything off. But for public companies, we usually use the going concern approach. It uses this really clever mathematical formula to calculate the value of a company that's growing at a steady, constant rate forever and ever. But what about that third method, the multiples approach? This is by far the most common one you'll see in analyst reports. It's everywhere. And honestly, it's the one you should probably avoid if you're trying to find a company's true intrinsic value. Damodaran has this brilliant phrase for it. He calls it relative valuation in drag. Because when you forecast cash flows for 5 years and then just slap an exit multiple on the end, you're not actually calculating intrinsic value. You're just doing a relative valuation, comparing your company to what others are worth, but you're disguising it with a few years of cash flows up front. Those early cash flows, they're basically a distraction. The multiple is doing all the heavy lifting, and your entire valuation just boils down to a guess about what someone else might pay for the company down the road. Okay, so with the multiples approach out of the picture, we're left with the going concern value. And it's a really powerful tool, but like we said, it can be mischievous. To keep it from running wild and giving you crazy numbers, we need a framework, a set of 4 simple but really powerful rules. These are the 4 golden rules to keep your terminal value in check. First, you've got to cap your growth. Second, don't wait too long to assume the company stabilizes. Third, be realistic about long-term profits. And fourth, make sure the company's characteristics actually match a mature firm. Let's break each one down. The first rule is just a massive reality check. The growth rate that you assume a company can maintain forever cannot be higher than the growth rate of the entire economy. It's simple logic, right? A company can't grow faster than the economy forever without eventually, becoming the economy. And that's not going to happen. So how do you estimate the economy's growth rate? Well, a fantastic proxy is the risk-free rate, like the interest rate on a 10-year government bond. And you might ask why? It's because both the economy's nominal growth and that risk-free rate are built from the exact same 2 blocks, expected inflation and expected real growth. It's a really elegant and logical cap to use. All right, rule number 2 is all about timing. You have to decide when your company is finally going to mature and enter this stable growth phase. And the advice here is simple. Don't get carried away. I know it's tempting to assume your favorite company will have high growth for 20 or 30 years, but history tells a very, very different story. For pretty much every company out there, the high growth party is over in less than a decade. And for most, it's just 3 to 5 years. So what kind of company can even justify a growth period that's closer to that 10-year maximum? It has to be a pretty rare breed. We're talking a small player in a massive market with absolutely explosive revenue growth and a truly powerful, sustainable competitive advantage. Rule 3 gets right to the heart of how capitalism works. High profits, or what we call excess returns, they're like a magnet for competition. And what does competition do? It pushes those returns down over time. So you have to ask yourself, can my company really fend off all its rivals forever? For about 80% of companies, the default assumption should be that in the long run, their competitive advantages just fade. Their return on capital will eventually equal their cost of capital, which means no more of those juicy excess returns. Only for the truly special 20%, the companies with incredible moats, can you justify assuming they'll earn returns above their cost of capital forever. And finally, we've got rule number 4. When you transition a company from its high growth phase to a stable growth phase, you can't just change the growth rate and call it a day. The entire profile of the company has to change right along with it. Think about it. A young, high-growth company is riskier, right? So its beta is high, and it probably uses less debt. But a mature, stable company is much less risky. Its beta should move towards the market average of 1, it can probably handle more debt, and because of all that, its overall cost of capital should actually come down. All of these pieces have to be consistent. So look, taming this final, dangerous number really just requires discipline. You can't let your assumptions run wild. Your terminal value has to be grounded in cold, hard economic reality. Here's the key takeaway. The next time you look at a valuation, I want you to run it through this simple checklist. Is the perpetual growth rate capped by something reasonable, like the risk-free rate? Is the high growth period actually realistic, 10 years or less? Are the assumptions about long-term profits believable? And does the company actually look like a mature firm in that final terminal year? Ultimately, that's the real test. This one number can be the difference between a rock-solid investment and a total house of cards. So you have to ask yourself, is your terminal value a foundation, or is it just wishful thinking?